Wall Street is whispering about $1 trillion valuation. They are painting a picture of an empire destined to rule the future. But if you look closer at the foundation of OpenAI, you might not see a fortress. You might see a house of cards. Today, we are dissecting the bearish case for the world's most famous AI company and why its empire could be on the brink of a spectacular implosion. Investors are pricing OpenAI as if it already owns tomorrow. With secondary share sales floating valuations between $500 billion and $1 trillion, this 7-year-old startup is being placed in the same league as Meta and NVIDIA. But here's the catch. That price tag does not reflect a business selling API calls. It reflects a fantasy. This is what we call the AGI lottery ticket theory. Backers aren't buying discounted cash flows from a software company. They are buying a call option on the invention of a digital god. If AGI arrives and OpenAI controls it, $1 trillion is cheap. But if it doesn't, the numbers collapse on contact with reality. OpenAI isn't just a company. It is a structured bet resting on 4 pillars that are already starting to crumble. Pillar number 1 is the incredible vanishing moat. In early 2023, GPT-4 was a king without rivals. It towered over everything. But look at the landscape today. Gemini, Claude, and DeepSeek have either matched or beaten GPT-4 on core benchmarks. The lead shrank from years to quarters to mere months. The secret sauce is no longer secret. Scaling laws, transformer variants, and instruction tuning are now standard recipes, not mystical arts. Every major lab can reconstruct the broad strokes. And the open-source world? Models like Llama 3 and Mistral are proving that for many enterprises, good enough and owned beats slightly better and rented. The technological superiority OpenAI relies on now decays on a 6 to 12-month cycle. This brings us to pillar number 2, an ecosystem built on sand. OpenAI sells tokens. It is a utility model, like an electric company. Compare this to Apple or Microsoft. They don't sell models, they sell environments. Operating systems turn foundation models into replaceable parts. Microsoft can wire Copilot directly into Windows and Office, making the actual model underneath just an implementation detail. Think about it. If OpenAI raises prices or lags on quality, Microsoft can dial its traffic to Gemini or a Llama model with a simple configuration change. Developers see the same thing. Tools like LangChain allow teams to flip between providers with a few lines of code. Vendor lock-in evaporates when every AI provider looks like just another API endpoint. Pillar number 3 is the too cheap to meter paradox. Sam Altman once promised intelligence too cheap to meter. But history has run this experiment before with nuclear power. In the 1950s, officials promised electricity would be free. Instead, nuclear plants cost billions to build and insure, while regulations kept prices low. They became low-return infrastructure plays, not high-margin tech darlings. OpenAI faces the same structural mismatch. Training frontier models costs billions. We are talking about $100 billion Stargate-scale facilities. Yet, the price of selling that intelligence is racing to the bottom due to competition. You cannot be a trillion-dollar utility while simultaneously promising a world where your product is effectively free. The math simply does not add up. And finally, Pillar 4, the financial black hole. OpenAI looks less like a startup and more like a capital incinerator. The spread between revenue and infrastructure spending forces a permanent state of fundraising. They are leaning on partners like Microsoft and Oracle, who carry their own massive debt loads. This financing loop looks like a perpetual motion machine powered by hype. The pattern is dangerous. Promise AGI to raise money. Spend that money on massive fixed costs. Then promise an even better AGI to justify the next round. If any link in that chain breaks, the unit economics are exposed. Investors are underwriting a negative cash flow utility while valuing it like a high-margin software monopoly. So, how does this end? There are three roads to ruin. Scenario 1. The IP strip mine. If economics sour, Microsoft, who already holds perpetual licenses, could simply absorb the talent and code, leaving the OpenAI shell to wither. It becomes a zombie R&D lab, while Microsoft sells the product. Scenario 2 is the WeWork implosion. With trillions in projected infrastructure needs, a slowdown in growth could turn long-term commitments into a nightmare. Creditors could push for a breakup, auctioning off assets. What remains would look like the husk of WeWork, a tarnished brand with a vision handed off to the highest bidder. Scenario 3 is the IPO exit scam. With private valuations so high, the only way to cash out early investors is a blockbuster public listing framed around GPT-6 or early AGI. But public markets price unit economics, not vibes. If they go public before fixing the black hole in their balance sheet, retail investors could be left holding the bag. OpenAI has changed the world. There is no doubt about that. But changing the world and building a sustainable trillion-dollar business are two very different things. Is the digital god already dead? Or can they defy the gravity of economics? Let me know your prediction in the comments below. And if you want to stay ahead of the AI curve, make sure to subscribe.